so you can watch. Okay. All right, we're getting ready to do chapter 7 for financial accounting, the intro problems. And I think we're going to get a chance to do the coursework too. This chapter is a little bit shorter, which is kind of nice. All right, and so now I'm going to share my screen and the sound so you can see what we're talking about. All right, and I'll keep my list of participants here so I can see if somebody comes in. All right, so once again, objectives. So this is called cash and internal controls. So a business has to have a certain amount of controls because you want to safeguard assets. You don't want assets walking off. They can walk off from customers and they can walk off from employees. So, and sometimes, unfortunately, it's just as much of a threat from employees as it is customers, right? Or vandals, right? So we also want internal control to have as accurate of information as possible. Okay. We have accounting has a lot of processes, a lot of paperwork, a lot of steps along the way to show that those steps have been taken. And we also want to be in compliance with law and regulation. So we don't want to mess with that, or we'll have the government on our case looking at what we're doing. So embezzlement, right? Embezzlement. If we have a chance, I'll go show you a very popular embezzlement case from Wichita, if you can believe that. You wouldn't think Wichita would make the news for sizable embezzlements, but I actually kind of have a direct link to this embezzlement, not in a bad way, but just who I know. So if we get a chance, we might go look at it. But once again, here's the idea, right? Our controls, our processes, our procedures is kind of like an umbrella here, and it protects our business, the information, the communication, the management, from something bad happening, hopefully, right? Something bad happening. All right, let's see here. We're looking at internal controls. So let's answer these questions. See if I can make sure that, all right. So identify each of the following as a control environment, a procedure, or monitoring. Okay. So, all right. So I'm going to go with the monitoring first. Okay, the monitoring. If you have external auditors, that's outside of your business, come in and review your controls. I believe that's monitoring. Okay, and if we need a little help to make sure we're answering correctly, this is found on page 364 of the ebook, right? So just putting in monitoring here. Okay, so we can check our work, right? And then the environment itself, I believe, is our personnel policies. And then the actual procedure is the safeguarding inventory in a locked warehouse. That's the procedure. That's the specific thing you're doing, right? And then if you have personnel policies, that usually sets the tone of the controlled environment. Let's see if I'm right. I got lucky. All right. So once again, a procedure is something that you specifically do. Maybe you have a code to get into the cash register, or you got to swipe your identity card or put in a number before you can operate something. Before I get into my Butler computer here, I have to put in my login, user ID, and password, right? That's trying to make sure that nobody's on my computer that's not me, right? Yep. That's the idea. Okay, let's go to the next one. Pretty easy, I think, but a lot of things to think about. All right, this next activity might be something pretty foreign to you guys. There was a time that a good accountant would never think about not balancing their checkbook. But in accounting, we call it cash reconciliation. Cash reconciliation. So we have bank accounts, right? Bank accounts to help us keep track of our money. Could you imagine what our society would be like without banks? Think about it a minute, right? Think about it. Without banks, we would all get pretty much paid with cash because there would be no place to store it safely, right? We would all be subject to crime on a, on a minute by minute basis, I think, just because people would, knew you would have that cash. So I'm not quite sure how we would store money without the banking system. If you got paid in cash every day that you work, you would have to take that cash home and hide it or bury it or put it in somewhere that nobody else could get to. And then anytime you wanted to pay for something, you have to go get it, so that'd be a pain. Wouldn't that be a pain? It would. I mean, people don't realize how important the banking system is, and it for business too, because it serves as a third party to help us keep track of our spending and where the money went and so forth and so on. And the only other thing I'll say, and I won't preach too much, most of this has changed because of online banking. We can go on our bank account at any given time if the software is working right, and is updated properly. We can go look at our balance anytime, pretty much, right? We could pay a bill on the fly. You don't have an online bank account? That's okay. It's okay. And it's okay. I'm not trying to place any judgment whatsoever. But so before the internet, and businesses still do this, they rely on the paperwork from the banks to tell them what's going on in their account. So they get those bank statements every month and go in and try to make sure that everything on that bank statement is accounted for in the accounting system. So we're basically going to learn how to balance a checkbook, okay? The checkbook, balancing a checkbook or balancing your cash account with what the bank says you have. It's also known as cash reconciliation. There are some terms that you might not know. And here's how I do balancing a checkbook. We have our book. We know what we've written checks for, if we wrote them down correctly. We know the deposits we've received, if we write them down correctly or put them in the system correctly. Then the bank has certain things that happen on their end, right? They may charge us a service charge for having the account. They may put interest in our bank account because it earned interest. So there's things that the bank knows that the book doesn't know, and there's things that the book knows that the bank doesn't know. And I always put the bank on the left. This is crazy. I always talk about the bank with my left side and the book with my right side. That's just how I have split them up. So we're going to learn a few terms here about balancing a checkbook, right? So if you see the initials NSF, that's insufficient fund check, okay? You can get a check from a customer that unfortunately they don't have enough in their account to process it properly and pay you, right? We can have an insufficient fund check where we wrote a check and it bounced for whatever reasons. We weren't keeping track of the balance. And then the main thing is errors. Errors can happen on the book side, no problem, because us accountants aren't perfect. And the bank also has errors, but they're constantly looking. I've had quite a few banking employees over the many semesters that I have taught, and they are actively looking to correct any mistakes they make. Come on in, Gavin. We're just doing the intro exercises, chapter 7. This is the funnest chapter all semester. I don't know if the word funnest is a good word, but cash is kind of fun because most of us have had some experience with cash. Gavin, have you had a job where you had any kind of connection with cash in a job, like a cash register or anything like that?
Mm-hmm. Not a cashier.
Okay, not necessarily. But we've all had personal cash, like a checking account, things like that. So I think this chapter is the most easily relatable as far as an individual is concerned, even though we're talking about it from the business point of view. All right. We're on number 2 of the intro problems in chapter 7. So we're just identifying what an insufficient fund check is. That's a bounced check. Most of the time in our book, it's going to be a bounced check from a customer. All right. So customer's trying to pay us. We're processing that check. It doesn't go through right. So that customer still owes us, right? If a check doesn't process right. So here's what it says. Indicate whether each item would appear as a debit or a credit memo on the bank statement, and whether the item would increase or decrease the balance of the company's account. So once again, I always put everything to do with a bank on the left side of any comparison I do, and then the book information on the right, okay? Company's books versus the bank versus the book, right? They both start with the letter B. I know. So an insufficient fund check. Who's going to know about that first? The bank. The bank's going to know first, right? So an insufficient fund check means that what we thought was going to appears on the bank statement as a debit. Okay, so it should be, let me see, and we have to be careful here with the way we're looking at it. So, all right, let me see if I'm gonna. Now my brain is going. Did I? Yes, there we go. Here we go. So a debit memo. Now be careful. Be careful. When the bank says that it's a debit, okay, here's what it says. Consider whether the item results in a decrease or an increase in cash. Okay, we thought this was going to be adding to our bank account, but it actually ended up not adding to. A debit or credit memo reflects the bank's position, not the company's. In other words, a credit memo indicates entry on the bank statement of an increase. So be careful. This is opposite of what we've been trying to teach you. You know that? So when it comes to a bank, a debit memo, this is from the bank. This is from the bank's point of view, not our point of view. A debit memo actually decreases the cash, the company's book. Okay, company's books. So we're gonna have to keep that in mind now. The opposite is true, and this is why we get confused over debits and credits, by the way. Okay, this is why we have so much trouble. Let's go ahead and answer these, and I'll explain that here in a minute. All right, so an insufficient fund check. The bank knew about it. It appears as a debit memo, and that is going to be a decrease in the company's bank account, okay? From the bank's point of view, okay? Bank's point of view. A bank correction of an error from posting another customer's check, okay? So a bank correction. So the bank is the one that made the error, right? Made the error. Bank correction of an error from posting another customer's check to the company's account. So this is going to be, they're correcting it. Okay, let me see if I've got this. So I have to switch my mind. I have to do the opposite thing in my mind. So here's what's happened. The bank took a check and pulled the money out of our account that wasn't our check. That's what it is. So this is a bank error. If the bank makes this error, they really need to pay us back for the error that they made. So this is going to be a credit memo because the bank made a mistake. Okay, bank made a mistake and they're going to put the money back. Okay, put the money back. How about an EFT deposit? Okay, that's an electronic funds transfer deposit. What that's going to do is should be a credit memo because it's a deposit and it should cause an increase. Now, let me see if I've got my line of thinking. Yep. And then loan proceeds. So if you just took out a loan, the proceeds of that loan is the money that you're getting for the loan, right? So I believe that's going to should be a credit and it should be an increase from the bank's point of view. Yep. Whew, that was tough because I don't look at it from the bank's point of view. Can I show you why? Those of you who are on screen, I don't know if you can see me. I hope you can. I'm going to show you why we have so much troubles with debits and credits because I usually don't go into this, but I'm still going to show you. So let's say that we have a bank account. Okay. I want you guys to watch this. So this is the bank's accounting system, right? The bank's accounting system. So let's say that we go to the bank, we've got $500 and we open an account, right? For $500. Okay. Here's what the bank sees us. To the bank, every customer is a liability. Okay. Every customer is a liability because I bring the cash to the bank. The cash at the bank goes up, but they create a liability for my account from them to me. Okay, because they owe me that $500 because I've given it to them for safekeeping, basically, right? Safekeeping. So when you bring a $500 deposit in, the bank is showing that the cash went up, and then they create a customer account liability for your account. So when they credit your account at the bank, they're making your account go up. When they debit your account at the bank, they're making it go down. But when we look at our books for cash, when our cash goes up, we debit it and we credit it when it goes down. So it's the opposite side. And sometimes when you've got your mind going the accounting way, you got to look at it from the bank's point of view. And that's the complete opposite. And if you ever get those little check registers with if you still have a debit card, you get a check register to record what you spent. When you debit an account, you're actually making it go down in that book. Well, that's because of this account right here. This account right here explains all the problems that we have with debits and credits. But it's from the bank's point of view. And it's from a liability standpoint. And you know that a liability goes up with a credit and it goes down with a debit. So I drew these to show you this is the bank's point of view of an account. Okay. And that's why the debits and the credits are kind of backward. No, they are backwards to the way the accounting system teaches you. All right. So this is the bank's point of view of any customer account. All right. So that's all I can do is try to show you how this works. And I don't tell you that at first when we're learning debits and credits because I don't want to confuse you even more, right? It's just too much. So, all right, let's go ahead and keep going now. See what else we can knock out. All right. Once again, that is bank reconciliation vocabulary, right? That we just went through. Okay, just went through. All right, let's bring this back over now. Okay, I think we're ready for number 3. Number 3 is an algorithm problem. So you're going to have different numbers than I do. Okay. Now we're going to do a bank reconciliation or a cash reconciliation. It's also known as balancing your checkbook. Okay, let's go ahead and figure out what's going on here. Here is an example of a bank reconciliation. So we're going to take a look at this too, and then we're going to put this in. So the first step of any bank reconciliation is, notice, here's the cash balance for the bank statement. Now this is going vertically. Most of the time I like to make mine horizontal, right? But the bank is still first, and then the book is on the bottom. And I put my bank on the left and I put my book on the right if I do it horizontally. The first thing we start with is the balances, right? What does the bank say we have? What does our book say we have? And most of the time, it's going to be different. The reason for the differences is timing and errors. Okay, timing and errors. The timing isn't near as bad as it used to be. With the internet, we get pretty much instant stuff, right? So you go to Walmart and you pay with a check. Guess what? They process that check right then and there, and the funds pretty much come out of your account and go to them immediately. Used to be, before the internet, you could write a check to someone. Maybe they wouldn't take it to the bank for a week, and then by the time they took it to the bank, it might be another week or so before it actually pulled out of our account. So that's what, about 2 weeks. That's called floating a check. Some people still do that. Some people get Christmas bonus checks at the end of the year, and they stick it in their wallet. Gavin, I'm sorry, I'm zooming in. They stick it in their wallet, and they say, I'm saving this for a rainy day. Well, that may be true, but do the accountant a favor and go ahead and put it in your account so that it processes. And then you can segregate it and separate it however you want to save your own money. But some checks expire after a certain time now. They used to not do that. My father would put checks on his dresser that he would get from places and thinking he was being slick. Well, he left them there too long. Some checks have a 60-day expiration, and you're out of luck if you wait, right? But I've worked at several places that I did payroll, and I would do bonus checks, and sure enough, there'd be 2 or 3 checks that most of the salespeople, I knew who it was that wasn't putting their check in the bank. I said, look, you can hide your money from your wife if that's what you want to do, but don't go not putting the check in the bank, because then it just continues being an outstanding check for me as the accountant for the business. So we're going to start with the balances. Then we're going to have certain adjustments to each of these balances. We're going to have additions, perhaps, and deductions. We always put the additions first and then the deductions. So let's walk through this. Let's go ahead and put at the top of our bank reconciliation the bank's balance. Okay, so what is the adjusted balance of the reconciliation? So they don't give you a reconciliation here. We're going to create one. Okay, so I think I've got one on my spreadsheet here. So I thought I forgot. All right, here it comes. Here it comes. All right. Once again, reconciliation is several adjustments to both the balances until they balance. Okay. And if you can't get it to balance, you haven't worked hard enough yet, or you haven't found all the pieces of information yet that you need to, because that's why it sometimes takes a little while to balance a checkbook, because you're not sure where the difference is coming from, right? So I'm going to move this over so we can watch this a little closer. Here is the bank balance. Okay, you guys have a different one than I do. So if you want to follow along, let's put the amount of the balance in for the bank. Let's put the amount of the balance for the company's books. And right away, here's my difference. Here's my difference. Now, they're not asking for it, but I wanted to show you that starting off, here's how much of a difference my bank balance is, right? Here's what my books say I have in cash. Here's what the bank says I have in cash. That's quite a bit of difference. That's almost $8,000 difference. Well, what is it? So now we've got to find it, right? So here's my simple strategy for balancing a checkbook. Whatever they say, I say, who knew about it first? So if there are bank service charges, right? Who did those charges? The bank did. So the bank knew about it first. Who didn't know about it? The book. So the book needs to adjust. So I'm going to go over here to the book and I'm going to put a service charge. A service charge from the bank means that they charged our account for having an account at their place, right? Some checking accounts have service charges, and usually they happen once a month, right? So that's going to actually be an adjustment to the book side of things. Okay, the book side of things. Let me go ahead and take these others out of here, and we'll put them in here as we need them. Okay, so, all right. So far we've got the service charge. That's it. The service charge. Well, the service charge didn't help us a whole lot. So here's where I'm going to do. I'm going to do another balance here. Just a second. Equals. And I'll show you why it's called balancing a checkbook. Balancing a checkbook. Okay, so after that service charge, we now have a difference of $7,900, right? $7,900. All right, so now let's go see what other items have come in that we know about. I'm going to put that in as green. Okay, the next one, a deposit in transit. So a deposit in transit is a deposit that we have taken to the bank, or we took a picture of it, click, and sent it on our bank software. Sometimes some deposits don't show up immediately for us to use. They take a little bit to process. So the book knew about this deposit in transit, but the bank isn't showing it yet. So we're going to put DIT, and that actually increases the bank balance, okay? Increases. So this is called deposit in transit. So that's what this, so deposit in transit, or DIT. DIT, it adds to the bank balance. And I've got $3,200 because I already know about it. It's already in my books. Yes? Because we're pretending that it's hit. Because it should soon, anytime. That's a very good question. That's exactly right. This is what should be happening soon. And we've already added it to ours. This balance reflects that already because we already know about it. Okay. So good question. Okay. Then a note collected by the bank and has $170 worth of interest. Okay. The bank knows about collecting that note. So there's going to be an adjustment to our book side. All right. And it says with interest. So this is going to be a plus. Okay. Because this is a note that they collected for us. So somebody owed us money that sends it to the bank. Okay. So we must have some loan that we've loaned out somewhere. All right. So we're getting $4,600 added as the bank note, the bank note collected. Okay, so that's an adjustment to the book side because the bank knew about it first. Okay, this last one is called outstanding checks. And I don't care if you don't have anything else. If you're a business, a lot of times you have written a check that just hasn't processed yet. Or you wrote a Christmas bonus check to an employee and they're carrying it around in their wallet. So your outstanding checks, we wrote the checks, so we know about them. So the bank hasn't seen them yet. So we actually have to subtract those outstanding checks because the bank hasn't seen them yet. Okay. So another example of an outstanding check today is when I go to Target, I've got my bank account hooked to my debit card. Yep. Basically, go ahead. That's just part of this. And we're going to, when we get finished here, I'm going to show you the entries for adding or taking out the cash from the book's point of view. Very good question. We're not going to do any adjustments to our cash account on this end, okay? But all right, so now we balance, right? This amount equals this amount. So that's what they're looking for. They're looking for what is the adjusted balance. This is a balanced checkbook, all right? So my balance here is $13,850. So if you'll put that down, that'll work. Now, you say, here, what do I do now? All right, what do we have here for the book? We have a bank note that we collected, and we need to make our cash account go down by $40. So we need to make our cash account go up $4,600, and then we also need to back out $40. So I'm going to put a beginning balance here. Here's the beginning balance in our cash account. And that is exactly that balance that we started with, okay? When we add $4,600 here, we are also going to subtract 40. Now, remember, these are journal entries, right? Yep. So every time we put a credit here, we got to debit something. And every time we put a debit here, we've got to credit something. So here we go. Okay, I guess all right. So let me show you. So when we do, let me move this over. I guess I didn't finish this one out. So let me show you T accounts here for those offsetting that we need an offset to our service charge. Let's say that we probably put that in miscellaneous, I'm going to guess. I think that's what they do. I would make a bank service fee expense account because I would want to keep track of how much that bank is charging me to use their bank system, right? So hang on just a second. Let me get this going here. So here is the account I'm going to use. Miscellaneous expense, miscellaneous selling expense or business expense, it doesn't matter. I think it's what it is. All right. And remember, that would be a debit. All right. So this is going to offset this $40 here, offset the $40. So that is going to be one of our entries. And then the other one is going to be a certain amount going down in a loan. Okay, and interest revenue. Okay, interest revenue. So there's that one. Okay, and then this cash we receive, it actually takes two different accounts to take care of this one. So I'm going to put a T account in here. Like I said, it's hard to believe that I didn't put these on here, but who knows? All right, there's that account, and then I'll make another one. Because the payment of the loan has two pieces to it that we have to account for in our books. I wish they wouldn't have done this because we haven't talked about how to take care of this in accounting. So they could have done something a little better. All right, so this one is going to be the loan the loan instead of a note payable, it's a note receivable. Okay. So note receivable. A receivable is an asset, right, with a debit normal balance. And when we received this cash and they said $170 is interest, right? Or whatever yours says. Okay, so now let me get this one. This is going to be interest revenue for that note. Okay, revenue has a credit balance. Okay, revenue has a credit balance because it is a revenue account. So once again, I'm going to go back over here and look at what my section says here. It says note collected, $170 of interest. So here's how you do it. You put the 170 in as a credit, and then the rest of my $4,600, right? This is my note collected of $4,600. I got to subtract, and then the rest of the credit goes to a note receivable. So let me just subtract these. All right, so that amount's going to be $4,430. So we got a credit of $4,430 to this note receivable and a credit of $170 for the interest. Now, we wouldn't have known that if they wouldn't have told us. Okay, so let's go make these entries now. See which one they want first. Okay, which one do they want first? Let's go down. So it says, let's record the service charge first. Okay, the service charge. Service charge made our cash go down. So we want the cash as the second piece, right? To making it go down $40. And let's see if I guess the right account. So we got miscellaneous expense. Yep, miscellaneous expense. But I'll tell you, if you have a bank account and you get charged a service charge for different things, you ought to separate that out and call banking fee expense or something. And don't put it in miscellaneous because you'll never remember how much each one is because there's other stuff in there, right? Okay, the other one is making cash go up. That is from the note that the bank collected for us. So that's going to be a debit to cash of however much your problem says. And then I would record a credit of however much interest they said. Mine said $170. So I'm going to put $170, and that should be interest. Wait a minute. Oh, they want the note first. Okay, sorry about that. Okay, so the bottom one is your interest. Okay, put the bottom one in as your interest. Now let me see if there's interest. There it is. Interest revenue. And then you put in the amount that you calculated for the note. Okay, this is how much. So when they pay us this $4,600, that's cash going up. And then part of that note is paying down a notes receivable. And the other credit is recording the interest revenue. And I'm sorry that they gave you an entry like that. And here's why. Here's how much the full payment from the bank. The bank put this in our account, right? So however much they say the note was collected for is the entire cash going up. Then you look at the interest. You put the interest down as the second credit and put that number in. And then this third piece or the second credit is what they call a plug number. It's the number that makes this balance. Once we know that interest is 170, that's actually how much of their note receivable they've paid down. Okay. Whatever the note is, what did they say they collected for your note? Okay, so let me show you yours. Okay, it's okay. It'll help someone else. Let's just do that note. Just a second. So here is your cash account. Here is your notes receivable because we loaned money to somebody that's paying us back. I know they went into
they went into a problem that I wish they wouldn't have, because nobody knows how to do this at this point. Okay, so when a note is collected, note involves paying some interest and paying down on the principal. Agreed? So what's your total note? How much did the bank say they collect? 4,000 what? 700. How much is your interest? 120. So the amount of the receivable going down is the difference. Yep. Because these two credits have to add up to this debit. You got it. See? That I bet you that helps someone else. Okay? Because that way you get an idea of, oh, that's how that works. Okay, so once again, yours should be what, 4580, right? Your credit here. These two have to add up to this. So there's your entry. Yep, there's your entry. Okay, let's check our work, see if we got it. If you need help with that, yes, thank you. And I still didn't get it. That's all right. There we go. And I got to put the amount in. Yep, I got too excited. There you go. Okay, but putting the, if someone came to you and said, like if you were doing this for a business, right? If you were doing this for a business and they said, Casey, I see that you debited cash for $4,700. What was that for? And you've done 100 entries since then. So you go, well, let me go look. I got to remember. And you go back in there and you go, oh yeah, that's the note that the bank collected for us on a note, a receivable that we had, and 170 was interest, and the rest of it was down on the principal. And you just answered it. Yep. Okay. The A, that's all right. That's okay. All right. So let's go back up. Here's what I want you to do. If you have something to write on, or if you're using Excel, let me show you how this bank reconciliation came together. Okay, and I'll draw it on the board too. And sometimes looking at it, it seems like looking at it from Excel, I don't know. Sometimes it just doesn't get it as well as a board. Okay, and it's okay. So let me show you, whenever you do a bank reconciliation, you need two columns. Always. Okay, always 2 columns. This is a bank reconciliation, and it's a good thing you're going to learn this, because we've got at least one more bank reconciliation in the harder problems. So it's good to understand this. Here's what I do. I always put bank on the left side and book on the right. Book, bank and book. Okay, so you put down the balance that it says. So you read your problem, and we'll do yours here on the board. So what does your problem say your bank balance shows? Okay, is that right? Okay, how much does your book balance show? $8,060. Okay, 806 of it. All right. So they don't balance, and that's to be expected when you first get started because of timing and errors, right? Timing and errors. And just for the heck of it, what's the difference? 17,150 is minus 860. We got a difference of $9,090, right? So we've got to find some adjustments to both sides that when we're down here at the bottom, that will be zero. That difference will be zero. It's called balancing a checkbook. If you look at a scale, right? Let's say you got two things on two sides of the scale and they're not balancing. What do? You start pulling some off on one side or adding some to the other side to make it finally even out, right? That's what we're doing. That's what we're doing here. So if you treat this like a scale, right? This side has to balance with this side. So right now, this side is tilting like this, right? Got too much in it. This one doesn't have enough. All right. So now read me your service charge. $20. So the bank put that in. The bank knows about service charges first. So if the bank knows about it, the adjustment goes to the one that doesn't know about it. So the adjustment's going to be, and there's always going to be adds and deducts. There may not be any adds, there may not, but you put them in this order usually, okay? We have adds and deducts. So this one is actually a deduct. This is the service charge, right? And I'll put SC for service charge. So that's going to go there, okay? What's the next item on your list?
Deposit in transit.
Okay,
1,800.
1,800. So deposit in transit. We know we took it to the bank. Yep. So, and a deposit makes it go up. So here, you said 1,800?
No, 2,000.
Sorry about that. 2,000 again?
800.
Okay. So here's your deposit in transit. We knew about it already. It's already in our balance, but the bank hasn't seen it yet. So this is going to be a plus here. Okay, this is going to be a plus. This is going to be a minus. What's your next item?
Note collected.
Okay,
4700.
right. And that was your note that we did over there, right? So who collected it? The bank. So the bank knows it. Which one doesn't know it? The book. Yep. So we're going to add your 4,700 here, right? And then what's the last piece?
Outstanding checks 7,200.
7,210. Okay. This is almost always a given. These are called outstanding checks. Now, I wouldn't even call them checks today because from an individual's point of view, but a business still pays with check quite a bit. You know why? Because it's an actual physical document. It exists. There was a time that when we got our bank statement back every month, instead of a copy of what our charge was, we actually got the checks that we handwritten out. They went all the way to whoever we paid, to our bank, to their bank, and back to us, all in our bank statement. That's why it took a month to get our bank statement in the mail, because they were waiting for all, I mean, it was the actual physical paper check that you signed your name on. You got that back. Okay, yeah. So some people miss those days. Okay, so here's what you've got, Casey. You've got a balance, plus, and minus. What do you get? I'll let you do the math.
12,740.
Okay. Is that what this is also?
Yeah.
Yep. So guess what? Is there a difference now? The answer is no. When there's no difference, you have a balanced bank reconciliation. Okay? When there's no difference, this reconciliation is now balanced. And that's the goal. In fact, in software, when you balance your checkbook in accounting software, if you get a balance, guess what happens? You get confetti on the software. Oh, we balanced. You know, believe it or not, I've stayed up all night looking for 2 cents that I couldn't find because I wrote down an amount wrong, or sometimes the bank makes errors. I had because when you run a check through the bank, if you write a check, you know, people's handwriting is not very reliable. And you know, you write the number on a check and then you spell out the number with words. They're very, right? The bank workers are trained to actually look at the spell out of the words as opposed to the number that's put in because people's handwriting is so bad. Well, I sent a check to my electric company for $300. Well, it must not have, the reader must not have been able to read it. And a bank employee had to key in the amount. They keyed in $800 when I only wanted to pay $300. Well, that means that they took $500 out more than I was expecting. And guess what? If I wouldn't have been reconciling my checkbook, I wouldn't have known where it went. I wouldn't have been able to prove nothing, right? So I had to call the bank and say, I think something went wrong. And see, I think it was an electric payment that happened for. Well, the electric company thinks that I'm just trying to pay up my bill ahead of time, right? So anyway, so it just happens. It just happens. So does this help? Okay, so now this can get much longer and there can be other things. So errors can happen. Whenever there's an error, whoever made the error is the side the adjustment gets calculated on, right? So if we make an error when we record something, we've got to either add or subtract from our book because of our error. If the bank makes an error, you've got to get a hold of them for one thing, because if they won't just find it on their own, you've got to let them know. If the bank makes an error, then they'll adjust their side. But you never adjust the bank side. Never. Not in reality. Here's the thing also. Let me add this. What you see here turns into journal entries. Okay? Turns into journal entries, because if we use Casey's cash here, let me show you how this will work. Here's Casey's cash. She started with $8,060. She took out $20 for a service charge. She added $4,700, right? And now her ending balance is the $12,740. So whatever the adjustments need to be made on the book side turn into journal entries, because what we thought was this much in cash turned out to be more. The opposite can happen too. Sometimes we think we have a certain amount, and when we get finished, something's come out that we didn't record yet. So good questions. I hope that helped kind of see it that way. All right. Whew. What else do we got? All right. Little bit. All right. This is a petty cash fund. You say, what's that? Sometimes it doesn't exist today, because most businesses, if Monty, if you worked for my business and you were going to go run some errands and I needed you to pick up something for a business, I'd probably just give you a credit card and you would go use it and buy it and bring back the receipt, and the credit card and the items. But there was a time we didn't have all that. We had to use what was called a petty cash fund. So you would take some money, cash money, the real currency, you would take it out of your checking account and put it in a locked box, in a locked desk, in a locked office. Lock, right? Why? Because it's cash. What happens to cash? It can be what? Walk off, right? I started an accounting position for a business. I'm not going to say who it is. And I was in charge of a petty cash drawer. And when I got to it, I said, okay, help me understand how you do petty cash here so that I keep it safe. My office wasn't locked. My desk wasn't locked. And neither was the container. And it's like, and I said, how am I supposed to keep this safe? Well, there was over $500 in there. And I asked him, I said, how much are we keeping in the petty cash fund? Oh, $500, $600, $700. Well, what is it? Which one? Pick one. Don't just give me a random amount. Well, that's how they did it. I didn't like that. And I didn't like being responsible for it either. Because what'll happen? If that gets taken and I don't have any to give out for somebody to go buy toilet paper with or whatever, then I'm on the hook. Right? So I said, I'm not doing this unless these things happen. This needs to be someone else's responsibility, not mine. Because I'm not going to be responsible for $500 that isn't locked up. well, what did that say to our employees? Didn't that say we don't trust them? I said, it says that we're trying to keep our assets safe. And just don't even give them the temptation, because you know darn good and well, those employees knew that that money was in there unlocked. So I'm really, but no, that really happened to me. And of course, I don't work there anymore, and I didn't very long, because they didn't take accounting seriously, they just treated it like tiddlywinks. Yeah, so there's some businesses that just say, I'll do what I want to. So, anyway, all right, petty cash fund, so what we're gonna do is we're gonna take money out of the cash account and put it in a petty cash account. Remember, this is a cash account also, so it's gonna have a debit normal balance, but we're gonna keep it separate from the actual cash account, which actually represents our checking, right? So really, today, unless you keep currency, now if you're I bet O'Reilly's has okay, if you don't mind me asking, do you know how much change you have in a cash drawer at O'Reilly's? You know about how much you have?
Like the one we did not do.
The one, okay, so you got your cash
Got
register.
like
Okay. Okay, either one. Is that there's probably a determined amount before you get started every time you do a shift,
Yeah.
right? Okay, okay. So at any given time, before the day starts, you've got $800 and how many registers? Okay, 8 registers. Okay, so if you have $100 in change in each register, there's $800. Plus the $800 in the back or whatever that is, $1,600. Or whatever, and you see what I'm trying to say? You keep track of what your beginning cash is for every day. And then every time you're finished with your shift, you ought to have everything that you sold and put into the cash register and that $100 to begin with, right? So if your drawer is short or if it's long, then there's other, there's procedures at O'Reilly's that take care of that. And that happens. It's just, it's us being humans. Sometimes it's us being humans. So anyway, I'm just trying to kind of make you think about it. All right. So this would be kind of like that too. So if you're going to establish a petty cash fund, then you need to determine how much. Okay. So mine says we issued a check to establish a petty cash fund. So we write a check from our checking account, which is what you call the original cash fund, and you go cash it, and then you keep that amount in one of your ledgers, right? So the petty cash fund was $700 in my example. So down goes cash in my original cash fund, which is often also known as checking. So I'm going to put the word checking here. But I bet you that O'Reilly's has an account that they keep for your change at your store, so.
Butler, lovely comments. Would like to.
I can't talk to you right now. Okay. Okay, all right. So down goes our regular checking account because that's where we're taking the money out of, and into the petty cash account it goes. So it's a debit to petty cash. Okay, and of $700 and a credit to cash, $700. Okay, so that's establishing the fund. You okay with that? Okay, that's just putting it in place. Let's just go ahead and check our work. Now we're going to reconcile the petty cash. Okay, if you'll put a reconciliation down, so when you reconcile petty cash, your receipts and the cash you have left in the drawer should equal your total petty cash fund, right? Yep. So here's how you do it. Here is reconciliation of petty cash. Just a second. So here's petty cash total, right? Put the total of your account down. Just put it down on a piece of paper. Okay? That's what it should total, right? My problem says that I have $700. Now I'm gonna go read what this is saying. The amount of cash still in the petty cash fund is 240. So I'm gonna put actual cash here, and it's $240. So I've got a little ways to go to explain where the rest of that money is, right? It says we have receipts of store supplies for 267. Okay, there's part of it. And by the way, these are the receipts. There was a time that if I gave you $20 to go get toilet paper, you would bring me back the receipt and the change, exact change. And you wouldn't add a candy bar down the bottom for yourself unless they said that was okay, or you're paying them back. You know what I'm saying? So, I mean, I'm trying to be fun. But anyway, I've had people do that and go, I don't remember us buying a candy bar. Oh. So anyway, store supplies, we had some miscellaneous selling expenses for 170. Okay, so let's see if this adds up to our total. Okay, miscellaneous selling expense. So a little tiny subtotal here at the side. I don't think we're quite there yet. Right, 240 plus 267 plus 170. How far away are we? So you need to do that for yours. 240 plus 267 plus 170. Okay, 677. How much am I short? Yep. So 23 bucks. Let's give it a try. If I add $23 to it, yay. So I'm short 23 bucks. You probably are going to be short something in your problem. So there's actually an account that you put when you're short. Okay, it's called short and over. Okay, we're going to make a journal entry, by the way. So this is cash, short, and over for that amount. So that amount, and that amount. So we're going to put an entry in that shows where these went, right? And we can't find 23 bucks. We can't find the actual cash for it. We can't find a receipt for it. You got to record it. Did you get in trouble? Maybe. How much? I bet you're O'Reilly. I'm sorry, keep using O'Reilly's. It's great though. I mean, it's perfect example. I'll use Dillon's. I'm sure Dillon's has an amount that a cashier can be short without too much hassle, right? Because there's a lot of money going in and out of Dillon's. 50 cents. Okay, so you're
not sure, I know what you both told me, that's like, check, like,
yeah,
for something.
right.
Is it on?
Okay.
We're running.
Sure. Because you know, the most important thing is to give the customer what they need as fast as you can, well, within reason, and make them happy, right? You can settle out all that later. But still, when a drawer comes up short or long, a long drawer means you've got more cash than you should have had. So you either didn't give a customer enough change back and they didn't count it, or I doubt you're taking money out of your pocket and putting it in the drawer. That's not. But the opposite sometimes happens. Sometimes employees think, oh, well, there's so much cash going on here. I'll just slip in a 5 here and there. Okay, well, we're dreams. And that is valuable, right? So it may not be the liquid cash that you can go spend anywhere you
Yeah,
want.
but maybe,
Yeah, because it's too,
but don't take out
There's,
All there.
and that's the inventory part, and that's chapter 6, you know,
More.
that's parts walking away. And whether they're fixing something at home, turn around and reselling it on a market somewhere, you know, who knows? So that happens everywhere when it comes to fixing things. My husband works for the Kansas Department of Transportation, fixes vehicles. And he said the number one reason that only certain people can go get parts is because those parts would disappear really quickly. So, yeah, so they're real particular about who goes and gets parts and what ones, and you gotta write down what you're gonna go get, and you gotta write down what you came back with and all that stuff. So yes, all right, so let's go through this. So let's put down, all right, so what I need, I've got a petty cash fund of $700. The amount on hand that I show is $240. So I've still got $240 in my drawer, so I don't have to add that back because it's already there. I've got store supplies of $267. I've got a selling expense of $170. And because these 3 items didn't add up to the full amount of petty cash here, just a second. I'm going to add up all of these again in Excel. All right. And so I had 677 that I could account for. And the difference is the $23 that is going to be short. Okay. My petty cash drawer was $23 short. I should have had either a receipt for $23 and then my drawer would not have been short, or I should have had an extra 23 in the amount of cash on hand. Okay, but this happens. That's what happens when you give money out and you don't count the change that came back with whoever you sent the money with, because you just can't assume. That's why we should all count money. If you're given change back from a purchase somewhere, we ought to take the time to count it. Every time I go to the ATM, I count what I get. Did I get that full $300? Because if I didn't, I'm going back into the bank and go, hey, I got shorted, you know. So anyway, we can't accept something just on blind faith. We have to prove it. So we're going to turn this into an entry. We've got to do an entry for these 3 right here. Okay, these 3 right here. So I am going to put store supplies. My store supplies are $267. So that's going to be a debit to store supplies expense. Okay, because this is showing where we spent the money. All right, and then I have miscellaneous selling expense for the 170. And then my cash short and over, right, is $23. So when cash is short and over, you debit it. Okay, so here comes my debit. Okay, here comes my debit. So let's see here. We want store supplies. You're going to debit for the amount of your store supplies. You're going to find miscellaneous selling expense, and you're going to debit for the amount of those. And then you're going to debit cash short and over for the amount you were short. So Casey, how much were you short? Did you know? You probably have gone on. That's okay. Okay.
That's all of them except for that 3 guys.
Okay. So now here's our debits. Our credits are going to be whatever these add up to, and that's going to be a credit to cash. Okay, good. So something close to 20-ish. And so then we're going to write a check, or we're going to write a check from the original cash account for the total of those 3 items, so that a person can go cash that check and put that money back in petty cash, so that drawer actually has the $700, right? So the amount that we need to make it back to $700 is the adding those together. Okay, so the journal entry becomes a credit to cash of 433. And if you take 433 plus however much actual cash you had on hand, it should then equal what should be in the drawer. Okay, yep. So the thing about this is when it comes to petty cash, you only make an entry. Now, listen, you only make an entry to this petty cash account on 2 occasions. When you're establishing it, how much you want it to be, or if somewhere along the way you're like, $700 is really too much. I would really feel more comfortable if it was 400. So if you decide to change this down to 400, then you would back it out of here and put it back in the original cash account. Okay, and then you would keep a $400 balance or whatever. Okay, last one, I think. Let me see if I got this. I think so. Uh-oh. I didn't do my math right. So hang on just a minute. 267 plus 170 plus 23. I can just do it right here on the screen. So right here, these 3 add up to 460. My fault. 460. Okay. So 460 plus, oh, of course, the 240. There is my, yeah. So the 460 plus the 240 should be $700. Is that right? 460 plus 240. Yep. Okay, even if my brain can't see it, that's all right. Last one. Okay, last one. We're going to do a little analysis here of our cash. Okay, a little analysis here of cash. This is called cash on hand. Days cash on hand. So this is a formula. Usually the last one we do on the intro problems has something to do with comparing things. All right. So I'm going to bring my numbers in here to my spreadsheet, and then we're going to go out and put it on Excel. All right. So let me put year 8 in. So it looks like I have cash at the end of the year of 24,000. Let me make this a little bigger. 24,500. Make sure you're following the right year or you won't get things correct. 10,230. Okay, then I have operating expenses of 62,430, and I have depreciation expense of 10,980. So I just repeated what my problem shows. Now I'm going to put in for the year 9, 25,400. Short-term investments, 7,030. The operating expenses, let me put that word there. Operating expenses, $59,030, and then depreciation expense. So these would all come from your financial statements. Okay, your financial statements, your balance sheet, your income statement. All right. So now what we want, because the formula is cash and short-term investments. So we're going to add cash plus short-term investments divided by your operating expenses divided by 365. Okay. So here's what I want. Okay. We're going to go into this spreadsheet. And we've got the numbers there. We're going to create a formula in Excel that does this. You say, what's the formula again? It's up here. It's cash and short-term investments. Okay. Plus, so you add those together to get your numerator, and then your denominator is your operating expenses. And your depreciation expense. Okay, so let me see here. I think we have to subtract. Let me put this down. Just a second. I'm going to also go look at this at the end of the chapter. I think we have to subtract our depreciation then, and then find the average balance of cash or the operating expense. Hang on, let me find this in the book. There it is. There it is. Okay. Here's what we're going to have. I'm going to recreate this here. So insert. So let's do the numerators first. The numerator is going to be your cash plus your short-term investment. So I'm going to put numerator here. Numerator is the top number. Okay, the numerator is equals 25,000 plus short-term investments, okay? Plus short-term investments, those two numbers together. And I'm going to put above that how much it is, because I like for you to be able to see how I got that number. So I'm going to put equals 25,400 plus 7,030. So 7,030 is what this numerator is. Okay, now I'm going to do it here. All right, we're going to take the cash plus the short-term investment, and I will go ahead and put that in also so you can see it. So it's $24,500 plus 10,230. Okay, and that's what this number is. So there's our numerator. Now our denominator is your operating expenses minus your depreciation divided by 365 days. Okay, so the denominator, okay, is equals your operating expenses, which is 59,030 minus your depreciation. There's a lot of times you have to take out your depreciation expense. It's part, they just don't want that in there. And then we're going to divide all of this by 365, right? Okay, so there's the formula. Now I'm going to make that happen. So equals 59,000 minus the depreciation, and then I need to put parentheses around this first part so that I can divide it by 365. Divided by 365. Yep. Yes. Okay, that's my denominator, and you're going to get a large number there. Just remember, we're going to take this number and divide by this number in order to get this. So I'm just getting my numerator and my denominator for the problem. Yep. So now let me do it here. So equals, open parentheses, oops. Okay, so we want just to see the formula, equals 24,500. Nope, got the wrong number there. 62,430 minus 10,980. And then that whole thing gets divided by 365. Okay, so that denominator ends up being the right amount. Close parentheses, divide by 365. Okay, no, that doesn't seem right. Okay, what did I do here? Oh, I divided it. That's what I needed to do here. For some reason, it took it times 365. So no wonder that's a big number. My fault. There we go. See, that other number was way too big. I accidentally in my formula took this times 365, and I couldn't figure out why that was so big. So then when I did it right over here, those numbers were way out of whack. So that helped me go, this doesn't seem right. So now what we're going to do to get the days cash on hand is we're going to put equals this number divided by this number, and the same over here. This number, this numerator divided by the denominator. Okay, I'm going to go ahead and calculate that, and then I'm going to do it in Excel here. So now this number is equals. Here's my numerator. divided by my denominator. Okay, so 255.80. Okay, if that's correct, I want to make sure that I have that right. Okay, yep. And then these two numbers look pretty similar too. All right, now let's try this one. So then my numerator divided by my denominator here. So those two numbers are pretty close. So I'm pretty confident. Now I'm going to put this in as a formula. So the formula will be equals, open parentheses, equals, open parentheses. We've got to do our cash plus our short-term investments, close parentheses, divided by, open parentheses, 59,000. Okay, so then it's the operating expenses minus the depreciation, and then we need parentheses around that. We need another set of parentheses. Okay, we do. So we need another set that then divides that amount by 365. And then, so here's your formula, I think. Let me see if I got this right. 255.8 days. Yep, it matched what I did here. So I'm going to do it again. Okay, for actually that goes below. Hang on, I got the wrong. See, the year 8 is first and then year 9. So I'm just going to copy it and paste it here. Okay, no, I'm not. I'm going to do it again. So just a minute. Let's just do it again. Equals, open parentheses. We want to go get cash plus short-term investments, close parentheses. That's your numerator. Divided by, put two parentheses, open parentheses, open parentheses. Then we want our operating expenses minus our depreciation, close parentheses, divided by 365, close parentheses. There you go. So there's the 246 days, 246.4. Okay, now we'll do for year 9, open parentheses, cash plus short-term investments, close parentheses, divided by, open parentheses, then the operating expenses minus the depreciation expense, close parentheses, divided by 365, close parentheses. There it is. Okay, now let's put those numbers in, and we should be finished with our intro exercises. I'm sorry that took so long. I did do quite a bit of explaining of things, which is okay. That's why we're here. It says round it to 1 decimal. Round it to 1 decimal. All right. And I need to do better about paying attention to, okay, it doesn't like that. Why not? Okay. Assume a $365 year, or 365 day year. I did that. What do you got? Did you get it? Okay. Try a different formula. Okay. Let me see here. Go back to my spreadsheet. Okay. And I want to make sure, all right, I want to make sure I've got the formula down. Cash and short-term investments, and then daily operating expenses. Daily operating expenses is operating expenses minus depreciation expense divided by 365. Okay. Let me, oh, hold on. Guess what? I think I've got them in the wrong spot. That's what it is. That's what it is. I've put them in the wrong spot when I put it in. Sorry about that. They want year 8 first. Good grief. So 246.4 goes there first. Yes. And then
255. There we go. So just be careful what year you put where. I know. When they put it up, when they put the newest year on the left, I always think they want the newest year first. So there you have it. Now you can compare. You say, what does this mean? This means that the cash that we had on hand last year lasted for 246 days, but this year it's staying longer. Okay, we're just trying to see the cash that we have on hand, so we're not buying as much as frequently. Petty cash isn't being utilized as much last year as it's not being utilized as much this year as it is last year. Okay, last year it didn't take as long to go through that, and that's what that means. Okay, that's it. Okay, I got about 35 minutes. Do you want to go ahead and try to start in on some coursework? You want to stop? How about we stop? And then we'll pick up the coursework for chapter 7 on Monday. Does that sound fair? Let's get out of here. I gotta quit recording. I hope this recorded, because that'll help me a lot. Let's see if it did. Yay, I think it did. Come on. So you guys on Zoom, when we work together again on Monday, we'll